Monetary policy today remains modestly restrictive, but not overly tight. And at its most recent meeting, on November 1st, that was just last week, the FOMC reaffirmed its commitment to achieving the 2% inflation target. Although the committee did not increase its target for the federal funds rate at that meeting, it left open the door to further policy firming if necessary to achieve 2% inflation. At the meeting, I expressed support for both aspects of that decision. That is, for maintaining the target for the federal funds rate and for retaining the option for further firming if necessary for restoring price stability. With current policy exerting modest downward pressure on inflation, given the balance of risks, we can afford to await further data before concluding that additional policy tightening is appropriate. However, if progress towards achieving 2% inflation stalls, I believe the committee should act promptly to ensure that inflation does not become entrenched. If the public comes to believe that high inflation will persist indefinitely, the resulting loss of credibility would make restoring price stability harder to achieve and entail greater economic cost. I'm optimistic that we can and will achieve price stability, but we are not quite there yet, and we should not declare victory and release the monetary brake prematurely. Price stability is critical for achieving maximum sustainable employment and a strong recovery. Therefore, we must remain vigilant until inflation is clearly and convincingly well on its way back to target.